Ever feel like you're stuck paying on a $50,000 auto loan for years? Well, what if I told you that you could actually compress that timeline down very fast using a tiny $1,000 line of credit at just $250 each and every month? Listen, you're probably going to want to grab a pencil and some paper because we're going to get into how to pay off this $50,000 really fast with just $250. Let's get into it. All right, quick truth. Amortized auto loans, they front load the interest. So early on, most of your payment feeds interest, not principal. And that's why small extra dollars early save outsized interest. Velocity banking flips the order of operations, so your cash actually lives where it crushes interest daily. And then it strikes the loan in bigger principal hits. Here's what I'm talking about. This is the engine, okay, with a small line of credit. We use a $1,000 line of credit as a revolving cash flow tool. Remember, your paycheck is going to be deposited into the line of credit. From the line of credit, you're going to pay your bills, and when the balance on the line of credit resets, what happens next? You send a chunk to the auto loan principal, okay, and then rinse and repeat. Remember, throughout this whole process, cash flow is king. So your $250 surplus that you have, that's the fuel that resets that line of credit balance quickly. So when your income gets parked inside of the line of credit, even for a few days, that average daily balance falls, so you pay less interest there. Meanwhile, the chunk, right, all those chunks that you send to the auto loan skip the amortization drip and cut the principal directly. Less principal time means less total interest on that loan. And it doesn't matter if it's an auto loan, a home loan, doesn't matter, right? This is the chunk size rule. With a $1,000 line of credit, you keep an initial chunk between 60% to 80% of the limit. So think $600 to $800 chunks towards the principal. Why? You get to control utilization. You leave room for bills and you keep the reset fast, okay? If you max out the line of credit, you lose flexibility and you risk those fees, okay? Cycle length, it depends on how fast you can restore the line of credit. With that $250 surplus, plus your normal income coming in, right? With the $5,000 coming in, let's say, when you're flowing through the line of credit, you're aiming for a 1 to 3 month rhythm. Quicker resets, quicker chunks, faster payoff. Now, if it takes you longer than the 60 to 90 days to reset, you are chunking too big. You see, this is why it works. Most personal lines of credit calculate interest daily on the outstanding balance. Lower average daily balance equals lower cost. So you're borrowing briefly at a manageable rate to kill off higher cost interest over many months remaining on the auto loan. Now, for those who are wondering, well, should I use a credit card or a line of credit? Well, the line of credit, to be honest, usually carries lower rates, clearer repayment, and fewer traps than a credit card does. Okay, rates are variable but negotiable, right? So these are the guardrails you're gonna have. Ask for the rate band and margin before even opening, okay? Confirm the fee schedule, set auto pay and alerts, and avoid overdrafts or cash advances. Folks, it's clean, it's simple, and it's controlled. And if you need help on that, listen, we've got the description link with the Velocity Banking Wizard. It helps you out with all of that. All right, so now let's go ahead and set up the tool right so it saves money from day one. Before you even apply for line of credit, right, pre-ask for everything. The rate, band, and margin over the index, the annual fee, if there is any, right? Draw fees, transfer fees, balance transfer terms, and any early closure fees. You want it all in writing, all right? If they can't disclose it clearly, then it is a red flag. Now, I also want to warn you about the utilization target here. We want to keep the average utilization under 50%, all right? Now, I know, if you want your credit score to be good, it's under the 30%, but when you're needing to get rid of a huge loan, 50%, okay? Spikes are fine when you chunk, but we bring it back down fast. That protects your credit profile, right? And your flexibility. So with a $1,000 limit, that means day-to-day balances near 300 to 500 and chunk spikes 600 to 800. Then we back down quickly, all right, when we do that. Now, look, folks, I don't know how you feel about this. However, auto pay does matter, all right? We want to set auto pay for at least the minimum plus a little extra, and then keep your targeted pay down cadence on top. This makes sure interest never compounds unnoticed. The calendar model is simple, right? Route your paychecks into the line of credit first, right? Every day they sit there, it drops your average daily balance. Pay your regular bills from the line of credit on their normal due dates. And then the leftover, well, that reduces the line of credit balance day by day. So as far as your checking account is concerned, we want to keep a small buffer in checking, $100 to $200 to avoid overdraft and NSF fees. So 100 to 200 there in your checking. If your income dips, pause those chunks, make the minimums, keep the engine safe, and protect your credit. Now, the negotiation script, right, is going to be straightforward. Just ask for no annual fee, no draw or transfer fee, and a rate review at 6 months of clean use. Many credit unions, they're going to work with you if you're a low-risk customer who avoids fees and pays on time. Folks, we have to document everything. This is a very important step, okay? Track your balance, your daily interest, chunk dates, and time to reset after each chunk. If your reset drifts past 60 days, shrink the next chunk. If fees start to appear, call and address them immediately. Many times you can get them knocked off, right? We are fee-proofing the method. That's what we're doing, all right? So with the line of credit set and guarded, we're gonna run 3 scenarios so you can see the speed at different APRs. Is that okay? So you'll learn the cadence, okay, the reset targets, and the exact chunk sizes that keep you in control and on pace. All right, let's set a clean baseline so that the math stays the same, okay? We're gonna use a standard 60-month auto at 5%, okay? So 60 divided by 12, that's 5 years, right? You keep making your normal monthly payment on schedule, okay? Whatever that monthly payment is. Velocity banking will sit on top, right? We're not skipping payments. We are cutting principal in leaps so that the schedule collapses, all right? We want to destroy the amortization schedule. So here's the play with a $1,000 LOC, all right? We aim for 600, remember, to $800 chunks of the $1,000, okay? So 600 to 800 towards that principal, right? And remember what it is. That's $600 to $800 chunks every 2 to 3 months. Now, why that range? Well, it keeps utilization, right, under control, leaves breathing room for bills, and resets fast with your $250 surplus, remember? So we want to always remember that. That's what we have. Now, when your paycheck parks in the LOC first, every day it's there, it trims the average daily balance. That means the line of credit interest cost stays tiny while your chunk hits the auto principal at full speed, all right? Now, watch this cadence. Month 1, you route income through the line of credit, right? And you're tracking that daily balance. Mid-month, the expenses flow out of the LOC as usual. And at the end of the month, the balance has drifted down because deposits beat withdrawals plus that $250 surplus, all right? So on day 1 of month 2, you have space. You drop a $700 principal only payment to the auto loan. That's month 2. And that chunk does not wait in line behind the interest. It slams the principal today. Now, during months 2 and 3, your $250 surplus plus normal deposits keep resetting the line of credit. Now, if your typical cash flow allows, right, and we all have different cash flow models and different sizes, and that's okay. You're gonna see the line of credit balance slide back towards zero inside 45 to 60 days, all right? That's your green light. Month 3, you repeat. So another $600 to $800 chunk, depending on how fast you reset. Keep the reset under 60 days when you can, and if it stretches to, let's say, 75 to 90 days, shrink the chunk to $600 until your rhythm tightens. Why is this fast at 5%? Well, the auto's APR is moderate, but amortization front loads the interest, especially early. Every chunk you send today erases interest that would have accrued for years on that principal. What you're doing is you are using a low-cost, short-term line of credit balance to save months of higher-cost auto interest over the remaining term. So the spread is real because what? Because time is the multiplier. Now, these are the common mistakes here. Don't send a $900 or $1,000, right? Don't send a $900 to $1,000 chunk to the principal, all right? And leave the line of credit pegged with no room for bills. What does this do, all right? That creates fee risk and forces you back to a checking account, back to checking, right? That breaks the daily interest advantage. So don't forget to mark principal only on the auto payment if your lender requires separate routing and extra principal. And do not ignore utilization alerts. Set one at about 70% so that you never drift, all right? So now, let's go to a checkpoint. Okay, remember, not 900 to 1,000. Remember your limit. After 2 or 3 chunks, look at your amortization, okay? You should see your principal balance far ahead of schedule and your scheduled interest shrinking per payment. That right there is the proof. If your line of credit rate floats up a bit, you just tighten the cycle. There's nothing to be worried about. Shave the chunk by $100 so the reset lands inside the 60 days. What does this do? This keeps control by controlling the reset time, not by gambling on bigger chunks. All right, so this is the takeaway for the 5% APR. Smaller, steady chunks win. The line of credit cost stays low because average daily balance stays low. Your $250 surplus is the engine. So you are compressing years into months by forcing principal down early and often. Now we move to the core case, 7% APR, which is actually common on the autos today. It's the same baseline. You keep the normal payment, all right? Keep going with that normal minimum monthly payment, whatever it is. Velocity banking layers on top, right, to attack the principal. The difference at 7% is the spread between the auto and the line of credit matters more. And the payoff in months saved is bigger when you keep the reset tight. Chunk sizing stays disciplined. $600 to $800 to start, okay? You target a 60-day reset, and what that means, from the day you chunk, you want your line of credit back near zero in about 2 billing cycles, okay? And that's thanks again to your $250 surplus, all right? And your income parking within the line of credit first. So if you see the reset drifting past that 60-day mark, the next chunk shrinks, all right? If you are resetting inside 45 days, you can actually nudge towards $800 without stress. So let's walk a sample cycle. Day 1, you're sending $700, okay? This is day one, $700 towards where? Principal only chunk, okay? Principal only chunk. That auto balance drops immediately by $700, and the interest you would have paid on that $700 for the rest of the term is gone. Meanwhile, the line of credit now carries that $700 for a short window because your deposits live in the line of credit. Remember? The average daily balance starts falling fast. Now, over roughly 2 months, you deposit paychecks, you pay bills, the surplus stays inside, and the line of credit slides back down. The interest cost on that line of credit for that short window is tiny compared to the long-term interest you avoided on the auto. I want you to do this. I want you to think of your cash like soldiers. They live inside the line of credit barracks, all right? Not out in the open checking account. From the barracks, they launch a strike on the loan, right? Then fall back to base and recover. So if you let deposits bypass the barracks and go straight to checking, you lose the daily interest edge. That's the mistake most people make. The thing most people miss is that where your money sleeps at night changes the math. Risk controls matter more at 7%. Let me say that again. Risk controls matter more at 7%. You got to set an alert at 70% utilization and another at 85% as a hard ceiling. So if prime moves and your line of credit rate bumps, call for a rate review. That's okay, right? You ask for that clause up front. Also, audit fees each statement. Audit them. If a transfer fee appears, you escalate. We mitigate by getting terms in writing before opening and by staying a low-risk user, right? On-time payments, low average utilization, no cash advances, okay? We're talking about low-risk user traits. Now, what do you get for doing this clean? Well, for instance, you get fewer total payments because principal falls faster. The same scheduled payment now carries more principal than interest, okay? So that means more of your money is going to pay this down versus paying the bank. Your timeline shortens without lifestyle stress because that $250 surplus fuels the engine. The velocity comes from cadence, not heroics. All right, so now let's go ahead and deal with the what ifs, okay? Of course we have them. We all have them, don't we? What if you feel tempted to do a bigger chunk to speed it up? If that pushes your reset past 60 to 75 days, it actually can backfire. Interest on the line of credit is daily, remember? A longer reset costs more and raises utilization, which can nudge credit. So keep it tight, keep it tight. Cash flow first, chunk second. If you remember nothing else, remember the reset time is the throttle. So here's the simple rule. This is what you set for a 7% APR. Are you ready? Route every deposit into the line of credit. Keep the chunk size at 60 to 80% of the limit. Watch reset days like a hawk and adjust chunk size to stay inside 60 days. Review rates and fees monthly. Now, if terms worsen, shrink chunks or pause until you renegotiate. Do this and you'll see the auto balance collapsing faster than you thought possible while your line of credit cost stays small and controlled. Let's go ahead and go to the third scenario. Okay, now we turn up the heat. At 10% APR, the interest drag is heavy, which actually makes disciplined velocity banking even more valuable. The stakes are higher, but so is the payoff. If we keep the reset tight and the fees at zero. Here's what we mean. We tighten the chunk size to start, okay? Instead of 600 to 800, let's go ahead and tighten it up to 500 to 700. Why is that? Why smaller? Well, two reasons. First, the line of credit cost is variable. Okay, remember, if you have a variable. So we want fast 30 to 45 day resets to keep daily interest tiny. Second, smaller chunks, they lower utilization, so you keep breathing room for bills and stay away from 80 to 100% maxed out territory. Remember, discipline beats aggression here. So here's the execution. Day one of your cycle, you route deposits into the line of credit, okay? Like always. When you see the balance sit low with space, you drop a $600 principal only chunk, right, to the auto loan balance. That auto loan balance falls today. The line of credit balance rises, but now your deposits go to work. So over the next 30 to 45 days, the paychecks land inside, the line of credit, bills flow out, and the $250 surplus shrinks the average daily balance fast. The cost you pay on the line of credit for those days is small compared to the long months of 10% you just erased on that $600, all right? So 2 tight reset cycles, right? Then reassess. If you are hitting 30 to 40 day resets easily, then go ahead and test that $700 chunk. If resets creep past 45 days, bring that chunk size back down. The goal here is control. We run the throttle with reset days, not bravado, all right? Notice, we're not afraid of variable interest anymore, are we? No, because we know now how to pay off our lines of credit. We know now how to pay off loans. So safety levers, well, they're non-negotiable at 10%, all right? Never let utilization sit above 80%. Set those alerts at a steady 70% and 85% and respond the same day. If income wobbles, pause those chunks immediately, all right? Make minimums. Keep deposits flowing into that line of credit and rebuild your cushion. Do not chase bigger chunks. No. When draw or transfer fees appear, don't do that. Ask for waivers up front and escalate if a fee lands. Remember, we mitigate before we open the account by getting the fee sheet, okay? Get it in writing, and the margin over index. Let me say that again. Perhaps you're not familiar with it. Margin over index, and we need that all in writing. So optimization is your friend. If you can refinance, go ahead and do it. You know, we're not afraid of any of the banking tools, all right? We know how to use them now. If you can refinance the auto later to a lower APR, please do it. Velocity banking still compounds the win because you have already moved principal early. So after 3 chunks, go ahead and measure it. Are you saving months? Is the reset stable? If yes, continue the cadence. If no, tighten the chunk or the timing. The reason this works at 10% is time. You're pulling interest forward and deleting it by cutting principal now, while keeping the line of credit cost brief and predictable. The headline rule stays the same. Cash flow first, right? Chunk second. Keep chunks smaller, resets faster, and fees at 0. And the high APR, that'll stop being a sentence and it'll become a target. All right, so let's make this run on rails, all right? The routine is simple and repeatable, so you do not waste decision energy, all right? Step 1, route every paycheck into the line of credit first. So let's say you've got that $5,000 or whatever it is, route it into the line of credit first. No, lines of credit don't have a direct deposit yet, so you're gonna let that check hit your checking account, and then you're gonna deposit it into the line of credit first. Even 2 or 3 extra days inside the line of credit lowers your average daily balance, which trims interest costs, and that's free money. Step 2, pay regular bills from, that's right, the line of credit on their normal due dates. Keep a 100 to 200 checking buffer for odd charges or merchants that don't like line of credit bill pay. The buffer prevents that overdraft noise, all right? Step 3, when your reset time proves stable, 30 to 60 days at the 7%, 30 to 45 days at the 10%, execute your chunk. to auto principal. Okay, market principal only if your lender needs that selection. Step 4, monitor utilization and reset days weekly. If a chunk pushes the reset past the target, shrink the next chunk by $100. If resets are landing early, you can nudge chunk size up within that 60 to 80% rule. Step 5, review the fees and rates monthly. Scan the statement line by line. If a new transfer or draw fee appears, call that day. You asked for waivers, right? And a rate review clause. Use them. Step 6, every quarter, update your amortization and project payoff date. Celebrate the months shaved off. It's okay to celebrate. That momentum keeps you consistent. Now, let me show you a shortcut. What are your thoughts on automating deposits? Okay, automating deposits, bill pay, and calendar reminders for chunk dates and statement reviews. Okay, let's reduce decision fatigue so that the system runs even on busy weeks. Check this out. Solar system, respiratory system, integumentary system, skeletal system. You know what those all have in common? System. Having a system works. So here's a critical mistake to avoid. Do not add new spending on this line of credit. It's a cash flow tool, okay? Not a lifestyle upgrade. So keep it clean. Income in, bills out, chunk, reset. And when you keep that loop tight, the math keeps working and your $250 in surplus drives real velocity. Now, we tighten the guardrails so your savings don't leak out in fees or rate creep. Okay, first let's talk about the fees. Before opening the line of credit, you already asked for the full fee sheet in writing. So that means annual fee, hopefully you don't have one, right? Draw fee, transfer fee, inactivity, and early closure. So keep that PDF, all right? Keep that documentation. Each month, you're gonna audit your statement line by line. If a new fee shows up, call the same day and request reversal. We are fee averse on purpose, all right? We gotta pay attention to the money because we know the banks are doing it, all right? Also, avoid cash advances if you can. They often carry higher rates and separate fees, right? Not that it's gonna hurt us, right? But every little bit we can do, man. We wanna get rid of this so that we can have the cash flow that flows from it. Okay, we wanna keep the line of credit clean. Deposits in, bills out, chunks to principal. So then the utilization is gonna be next. We target an average under 50% with brief spikes when you drop a chunk. Set 2 alerts, one at 70% as your nudge, one at 85% as your hard ceiling. Now, if you hit the nudge, slow down. Slow down that spending from the line of credit until deposits pull you back under. Now, if you ever approach the ceiling, pause those chunks immediately. High sustained utilization can actually poke your credit score and remove breathing room from bills. Remember, the engine runs on fast resets. Control the reset time and utilization takes care of itself. Now let's talk about variable rates. Ask for the margin over the index up front. And if they offer a review clause at 6 months, go ahead and take it. Then track your statements monthly. If prime moves and your rate inches up, you have options. Shrink chunk size to keep resets inside 30 to 60 days. And then call for a rate review or shop a credit union for better terms. The reason this works is the daily math, right? Keep the average daily balance low and the line of credit's cost stays tiny even when the headline rate wiggles. Credit health stays fine when you make on-time minimums, avoid late payments, and keep average utilization modest. Here's the liquidity rule. Never send a chunk that risks paying a bill late. Cash flow first, chunk second. If income dips and emergency hits, pause chunks, Keep the loop running with minimums, rebuild your cushion, then resume. Document everything in a simple sheet: deposits, chunk dates, reset days, any fees. Trend lines tell you when to adjust, and after 6 clean months, ask for better terms. Low risk behavior gets rewarded. Now, let's go ahead and launch this in a week, shall we? Let's go ahead and launch it. It's going to be quick, it's going to be simple, and it's going to be controlled. All right, day 1, you're going to list your debts, terms, and payments. Confirm the auto APR and remaining term. You need clean numbers. Day 2, call 2 banks and 2 credit unions. Request a $1,000 line of credit. Now, this is where you pre-negotiate. No annual fee, no draw or transfer fee, margin disclosure, and a 6-month rate review. Day 3, set auto pay for at least the minimum on the line of credit. Turn on utilization alerts at 70 to 85%. Add calendar blocks, statement review, chunk window, quarterly payoff check. All right. Day 4, route your paycheck to the line of credit. Keep about $100 to $200 in checking as a buffer. Test one small bill payment from the line of credit to confirm routing. Day 5, track daily balance. Verify expected interest on the math or on the statement or online dashboard. Adjust the buffer if merchants batch weirdly. Day 6, execute your first chunk, 60 to 80% of the line of credit limit, depending on your comfort, and set a reset target of 30 to 60 days. And then day 7, review that utilization, any fees, and your reset pace. If targets hold, schedule the next chunk date. If the reset looks low, plan the next chunk $100 smaller. And then we keep this going, okay? Repeat the deposit chunk reset loop. Each quarter update your amortization and projected payoff date. Here's the safety rule. If income dips or rates spike, shrink chunks or pause until stable. The engine restarts when cash flow is steady and fees are still 0. So here's the takeaway. Cash flow first, chunk second, and a small line of credit turns $250 into steady principal hits that beat interest with time and control. Now, if you want deeper help negotiating line of credit terms, or you want me to walk through a live amortization teardown, subscribe and watch the next video. Okay, comment your APR and we'll map your first chunk size. Like and share if this helped you move faster towards 0. God bless you, and we'll see you in another video.